For the class example exercise, I have pasted here exercise 8.5, page 339 to 340. So I just want to give you 10 minutes to read the whole example thoroughly. So here the requirement is that you have to use ABC costing and compute the customer margin of the Big Sky Outfitters, right? So just pause the video here and try to solve it by yourself and then compare your answers. So let's basically understand the question. We have company named Thermal Rising Incorporation that makes paragliders. Sorry. And they also deal with the custom design as well and also standard paragliders as well. So their customer is Big Sky Outfitters, and they want to know that whether the big outfitters like how much they are giving us profit. So the other data is that the company's direct labor rate is 19.50 per hour. So this is their activity cost pools, and these are activity rates. So this is the segregation of their standard model and custom design. So they ordered one order, each include 20 standard one. They have and there is 3 orders. Each order contains 3 custom designs, right? And this is how the data here: direct labor hours, selling price as well, direct material as well. I have pasted its solution on the next slide, and right now just try to solve it by yourself and then compare your answers on the next slides. Okay, so here how we calculate the margin. So the formula is sale minus cost, and all the cost is here, and at the end here there is margin. Okay, I'm gonna just erase this and I'm gonna left for some space for calculation here. Okay, so how many paragliders we have sold? 20 standard one and 3 custom design. Per cost of standard design is 1,850 and 2,400 for custom design. So here where this 44,200 came from: 1850 multiplied by 20 plus 2,400 multiplied by 3. Answer is here, right? So we have calculated the sales. Now let's calculate the cost. So the direct material, we know that direct material per model is worth of 564, and how many standard one 20 and custom one is 3. So what is the per unit cost of material is of the custom design is 634. So where this $13,182 came from? 564 multiplied by 20 plus 634 multiplied by 3. Answer is 13,182, right? Okay, now calculating the direct labor is a little bit tricky, so I hope I would make you understand this tricky part here. We know that we ordered 20 standard model gliders and 3 customs design gliders, right? So how many hours are used to calculate how many hours are spent to make one standard one? That is 26.35 hours are used to make one standard model glider. And what is the per hour rate is 19.5. right? So, and how much time is spent to make custom design paragliders? 28 hours, right? And what is the direct hours cost? 19.5. So where this 11,915 came from? Here we know that 26.35 hours are needed to make one standard model. So how much hours are needed on making of 20, and what is the per rate? 19.5. And we add it here, the custom one is that how many hours are used to calculate. So 28 multiplied by, we ordered 3, and what is the direct hour rate? 19.5. So answer 11,915, right? And now the supporting direct labors. So we know that $26 per direct hour rate multiplied by 26.35 hours, and we ordered how much? 20 gliders. Similarly, we ordered 3 custom design. 28 hours are used to make one custom design, and what is the supporting direct labor hours rate? 26. So hopefully you understand where this 15,886 came from, right? And now order processing. We know that order processing cost is 284, and how many orders we have placed? 3 for standard and 1 for custom. Sorry, 1 for custom. Sorry, 3 for custom and 1 for standard, right? So total order 4. So here it is, order processing charges here, and the custom design charges, because custom design charges are only applicable for the custom design gliders, only 3, you multiply with 3, right? And where this 558 came from? This is a custom design, which means 186 multiplied by 3. Good. And how many customer? So customer service is 379 per customer. Since there is only one customer, so you just multiply 379 with 1, answer is 379. So we add all the cost here. So here we add all the cost here, answer is $43,056. So we less from our sales, answer is, the margin is $1,144. So this is how you calculate customer margin, right? So if you still feel the need to explain some kind of values here, please do write us on our WeChat group and our Blackboard group, and write it down if you want to discuss it in our Zoom live meeting. Okay, let's move forward. Now question arises that what if we are using our traditional costing method, then what would be our product margin? So in that case, the scenario is going to be a little bit different. So we are given the data here, it is the same data. So 50 million is the sales, that how many units of short start and long life are sold, its respective data is given here. So let's see that. So we know that if we are using a plant-wide system based on manufacturing overhead, so total manufacturing overhead is 14 million. So 14 million divided by 800,000 of machine hours. How much? The question mentioned that 4.6 hours. It takes 0.6 hours to make one short star. So 800,000 units are sold. 800,000 multiplied by 0.64, answer is 480,000. long life is 320,000, so total 800,000 machine hours are used. So answer would be 17.5 per machine hour, right? So let's talk about that. So you multiply with simple one rate with both of these products. So machine hours 480,000 are used for short start. The answer is 8.4 million, right? So similarly, 5.6 million came from that 320,000 multiplied by 17.5. Answer is 5.6 thousand. This is how you divide our total manufacturing overhead 14 million onto two products, right? And when you find out the product margin, now here comes a big deal here, that the short start is giving us the product margin of 6.9 million, whereas the long life is giving us how much? $2.1 million of the profit as well, right? So in that case, our product margin totals 9 million. So did you notice something, that in our ABC system, when we implement that one, long life is giving us approximately $1.1 million loss, not like profit. So I hope right now you are getting my point. That is, if we use one rate, we get the nature are different for these two products. So if we use traditional costing methods, so the whole scenario is changed. So that's why we say that we are starting today a new chapter, that is activity based costing, a tool for decision making. So if you base your decision that we should go to produce more long life because it's giving us more profit, and you base your analysis on the base of traditional costing, so your decision is erroneous, wrong, and not according to the accountants or according to the knowledgeable persons or something, right? So that is the biggest problem for using traditional costing. So this slide is basically tells you what we have just discussed in our previous slide, that the ABC system tells us that the short start is giving us $8.372 million profit, while the long life is giving us 1.132 million loss. Whereas on the traditional costing, let me just change the color here, that would be better. So the product margin on traditional costing, the short start is giving us 6.9 million profit, whereas the long life is giving us 2.1 million profit. So the difference is here, the changes here is that it shows 1.4700, and here the changes shows 3.23 million. So if you just compare it in words, is that the traditional costing systems overcost the short start and reports lower profit, whereas the traditional cost system undercosts the long life and reports a higher profit margin, right?